Hello, everyone. Thank you very much and welcome back. Thank you very much for joining us once again. You hope you had a very good time. Okay, first of all, I would like to say apologies to everyone because I was supposed to share the presentation, but honestly, the week was so busy. I was not able to share the presentation. You know, this return season, so many timelines, so many deadlines. Apologies for this, but I'll try my best to share this presentation maximum by the weekend. Okay, as usual, we will start our discussion by recapping our previous lectures. Then we will be starting what will be the impact of corporate tax on the unrealized gains and losses. So let's start the discussion. Okay, in our previous lectures till now, we have discussed overview of the corporate tax law. We have discussed resident and non-resident taxable persons. We have discussed exempt persons. We have discussed out of the scope persons. We have discussed UAE sourced income, permanent establishment, and the history of the permanent establishment. Corporate tax registration based upon the guidance issued by the Federal Tax Authority. Application of corporate tax on partnership, application of corporate tax on free zones, application of corporate tax on the family foundations and trust. And our last lecture was how to compute taxable income. While discussing how to compute taxable income, we have decided that accounting profits calculated as per the prevailing accounting standard will be our base. And it will require some sort of adjustment. And the first adjustment that we discussed, it was the gains and losses, unrealized gains and losses. So this is the topic of the today. So first of all, we need to understand what is gain and loss on the assets. We all know this, what is the basically tax WDV or cost, what is the market value of the asset, it will be considered gain and loss. Assuming we bought one machinery value is 100,000 and the depreciation is 10%. After 2 years, the total depreciation for the 2 years will be 20,000. The remaining 80,000. 80,000 is my WDV, written down value. If I'm assuming my tax depreciation will be same like my accounting depreciation, assuming that the pattern of allocation of the assets, pattern of utilization of the assets same like as given in the accounting standards. So this accounting WDV will become my tax WDV as well. So this is the WDV written down value of the asset. If the market value of the asset is assuming 90,000, it can be 70,000 as well. So if this is at 90,000, 10,000 is my gain. Here 10,000 is my loss. This 10,000 gain, this 10,000 loss. This is how we can calculate. It can be gain or it can be loss. So this loss or this gain can be classified into two categories. First is unrealized or realized gain and loss. Realized gain and loss, if we're selling the asset and the gain that we're realizing at the time of sale, this is called my realized gain. And if I'm not selling the asset, just the gain that I'm booking in my paper, asset is in my hand, asset is reflecting in the books of account of the business, but we have some sort of gain, and this gain can be unrealized gain. So realized gain will be on sale basis and unrealized gain will be just in the papers, asset has not been sold. So this 10,000, whatever we have discussed on the previous slide, this 10,000, if the business is selling the asset and business is recognizing this 10,000, we will say this is a realized gain. If the business is not selling the asset and business is recognizing this gain or not recognizing this gain, it will be considered unrealized gain. We will discuss they need to recognize it or they should not recognize it. The question is basically in this whole webinar, whatever is the unrealized gain, we have just discussed cost is 100,000, depreciation, accumulated depreciation is 20,000, WDV is 80,000. Market value is 90,000. This 10,000 is my unrealized gain. The question is, do we need to pay tax on this unrealized gain or not? This is the major question for this whole webinar. Do we need to pay tax on this 10,000 unrealized gain or not? This gain, as I discussed, it can be a realized gain, or it can be unrealized gain. It will come in our next discussions. What the law says, basically, we need to go through this wording of the law collectively. So the Article 23 of the law says, for the purpose of calculating the taxable income for the relevant tax period and subject to any condition that the minister may prescribe, the taxable person that prepare financial statements on an accrual basis may elect, this word is very important, may elect. So whoever is preparing the financial statements on accrual basis may elect to take into account, to take into the account gains and losses on realization basis in relation to. So whoever is preparing the financial statements on accrual basis, the person can take into account the gains and losses on realization basis in relation to all assets and all liabilities. This word is very important as well. All assets and all liabilities that are subject to fair value or impairment accounting under the applicable accounting standards. This is the second thing. Or all assets and liabilities held on the capital account. This word is very important. At the end of the tax period, whilst taking into account any unrealized gains or loss arising in relation with the assets and liabilities held on the revenue account. This is the wording of the law. So what the law is saying? Law is saying if the businesses or if the taxable person is preparing the financial statements on accrual basis, an option has been given to the taxable person and they may elect to pay tax on the unrealized gain and loss on realization basis related to all assets, related to all liabilities that are being measured at the fair value or that are subject to impairment accounting. This is the option one. Second option, they have given that the all assets and all liabilities which are reflecting in the capital account, they may elect to be subject to tax on realization basis, and the all assets and all liabilities which are reflecting in the revenue account, it will be subject to tax on unrealization basis. So these wordings are very important. First, they may elect. Second, what is the realization basis? Third, what is unrealization basis? Fourth, what is fair value assets? What are the impairment accounting assets? What are the capital account? What is the revenue account? All these things we'll discuss one by one in this webinar. So as I mentioned, this is just summary of the law. All assets and liabilities that are subject to fair value or impairment accounting under the applicable accounting standard, it can be recognized on realization basis. So taxable person can opt to apply the realization basis, and all assets and liabilities that are subject to fair value or impairment accounting under the applicable accounting standards are held on capital account. On these assets and on these liabilities, taxable person can opt to pay tax on realization basis. However, the gain and loss on all assets and liabilities held in the revenue account will be considered an unrealized basis. That were discussed earlier. So the question, this means that the person can opt to be subject to tax. This is not compulsory. Can elect subject to tax on realization basis. If the person is not electing to be taxed on realization basis, then the person will keep paying tax on unrealized gain by the end of every year. So second thing, if whatever the treatment is being chosen by the person, it will be applicable on all assets and all liabilities. We cannot say like this, okay, this asset will be subject to tax on fair value. Sorry, this assets unrealized gain will be subject to tax on realization basis. This asset unrealized gain will be subject to tax on unrealized basis. We know we cannot pick and choose. We need to apply the same standard on all categories. All categories, it will be subject to tax On realization, gain will be subject to tax. Gain or losses will be subject to tax, or losses will be allowed on a realization basis, or it will be allowed on unrealization basis. Whatever is the treatment that we are adopting, it will be applicable on the whole category of the assets. So first person can elect, second it will be applicable on the whole category of the assets. So next is fair value and impairment testing. What are the assets and liabilities which are subject to fair value, which are subject to impairment testing? So generally, financial assets, financial liabilities as per the IFRS 9, and investment property as per IFRS, I think investment property IFRS 40. Biological assets IFRS 41, I think. And that fair value less cost to sell, intangible assets as per IFRS 38. These are the assets which are subject to fair value. So, and the assets which are subject to impairment testing, I think IFRS 36 deals with this. These are usually property, plant and equipment, goodwill, intangible assets. These are the assets which are subject to impairment testing. We need to look into this in detail. What are the assets which are subject to fair value? What are the assets which are subject to impairment testing? Usually, this is the category of the assets, as I mentioned: financial assets, financial liabilities, biological assets, intangible assets, and investment property. So if these assets are the assets which are subject to impairment testing, these assets are property, plant and equipment, goodwill as per the IFRS 36. So along with this, if as I mentioned, as we discussed earlier, if the taxable person is electing itself to be subject to tax on a realization basis, so these are the assets which are subject to tax at fair value, and these are the assets which are subject to tax at the impairment accounting. So assets and liability held on capital account. There are two different things. What we discuss: assets and liabilities held on the revenue account, assets and liabilities held on the capital account. Assets and liabilities which are held on the capital account, these are usually non-current assets, these are non-current liabilities, like machinery, property, plant and equipment, investment property, intangible assets. These are the non-current assets. It will be reflecting in the balance sheet. In the non-current assets category, these have a long-term life. It cannot be converted into the cash very quickly. So these are non-current assets, these are non-current liabilities. These non-current assets, these non-current liabilities will be reflecting in the capital account. As we discussed earlier, taxable person may realize, subject to election, gain and loss on the assets and liabilities subject to the fair value or impairment test and held on the realization basis. When the taxable person sells such assets and liabilities, the gain will be taxable and loss will be allowable. So whatever the gain they are making on the, if the assets are in the capital account, or if the assets are in the fair value treatment, or if the assets are subject to impairment testing, so annual basis, whatever is the gain or whatever is the loss, gain will not be subject to tax and loss will not be allowed for tax purposes if the person is electing itself. So whenever this asset will be sold on realization basis, gain will be subject to tax and loss will be allowable for tax purposes. So assets and liabilities held on the revenue account. So these are the basically short-term assets and liabilities expected to be converted into the cash or consumed within 1 year, like inventory items. So inventory items, these are the assets with a short-term life, and it can be converted into the cash within 1 year. So it will be recognized as assets and liabilities held on the revenue account. The assets and the liabilities are held for generating revenue rather than for use in the ordinary course of business. So this is the called asset held in the revenue account. So the second treatment that we discussed earlier, if the taxable person, so assets which are in the assets which are in the capital account, the person can opt to be subject to tax on realization basis, and whatever the assets are in the revenue account, those assets will be subject to tax. Those assets, the gain or loss related to those assets will be subject to tax on unrealized basis. So still for assets and liabilities held in the revenue account, the taxable person will have to assess the unrealized gain or loss by the end of every tax period and adjust the accounting profit accordingly. So this is a summary of our discussion related to the gain and loss. So first is assets and liabilities subject to fair value or impairment accounting. Assets or liability held on the capital account. Assets or liability held on the revenue account. The first is assets and liabilities subject to the fair value or impairment accounting. The question is elected gain and loss to be taxed at realization basis. The first question is the taxable person has elected that the gain and losses to be taxed or to be allowed on realization basis. If the person has elected itself that gain and losses required to be taxed or allowed on realization basis, then all such assets and all such liabilities, gain and loss related to all such assets, gain or loss related to all such liabilities will be subject to tax on realization basis. And if the person has not elected gain and loss to be taxed at realization basis, even these are the assets which are at fair value, even these are the assets which are at impairment testing, then on all such assets, liabilities, unrealized gain is taxable by the end of every year and loss is allowable by the end of every taxable period. This is the first that we discussed in 23 sub-article A, I think, AR1, whatever is. So this is the B. This area is 23B or 2. So first is all assets which are subject to fair value, which are subject to impairment testing. If the person has opted, subject to tax on realization basis. If the person has not opted, subject to tax on unrealization basis. Now, the second option given in the law under the Article 23 subclause B. Now the person, they are asking the person can classify the assets. These can the assets held on the capital account or asset held under the revenue account. Assets held under the capital account, person can opt to be gain and loss subject to tax on realization basis. So here, if the person has opted, yes, all assets will gain on all assets will be subject to tax on realization basis and losses will be allowed on realization basis. If the person has not opted, then gain will be subject to tax on unrealization by the end of every year and losses will be allowed on unrealization basis by the end of every year. Here for the assets and liabilities held on the revenue account, whatever the assets and liabilities like stock, like debtors, these assets and these liabilities are held under the revenue account. Once these are held under the revenue account, there is no other option, but we will have to pay tax on the unrealized gain and we can claim losses on realized basis. Hopefully everyone is clear regarding this. So this is the one example, pre-limited buy the stock for 500, which is part of the inventory item by the end of the year. The market value increases to 550. Pre-limited will be liable to pay tax on unrealized gain. So initially pre-limited, we are assuming that the person is not opting the option 23(1). But they are going for option 23(2) or B. So once they are going for 23B option, if they would have gone for A, then all it would have been subject to tax on realization basis. If they have opted 23(2), then these are the revenue items, so it will be subject to tax on realization basis. On the contrary, if the value of the closing inventory has been reduced to 400, they bought it 500, reduced to 400, 100 will be allowed as tax deductible expense by the end of every year. This is example 2. This is basically asset held on the capital account. Pre-limited has bought machinery 1 million, which will be used for business purposes and booked as non-current assets. The machinery tax WDV is 0.8 million. So this is, they bought machinery 1 million. 1 million, tax depreciation is 0.2, remaining tax WDV is 0.8. If the tax WDV is 0.8 by the end of second year, The market value of the machinery, there is a possibility it can be 0.9 million, it can be lesser than 0.8 million. If this is a 0.9 million, so once the market value of the machinery is 0.9 million, the gain is 0.1. This 0.1, we need to look into this. They are opting either 20, article 20, subclause 3, subclause 1, or the second option. In both of the cases, if the person is opting, this 0.1 will be subject. If the person is opting, it will be subject to tax on realization basis. If the person is not opting, then this 0.1 will be subject to tax on unrealization basis. In the same way, if there is a loss, if the person is opting, then this loss, whatever is the loss, it will be allowed on realization basis. If the person is not opting, then the differential, whatever is the loss, it will be allowed on unrealization basis. By the way, the law is silent about the pattern of allocation of the assets, and we can assume that the tax depreciation would be the same as per the accounting depreciation. So tax WDV will be equal to the accounting WDV, but we need to wait for the law. Usually it doesn't happen like this in the various jurisdictions, because pattern of allocation of the assets is usually different as treated by the tax authorities, and the pattern of allocation of the asset treated by the accounting standards. So once the pattern of allocation is different, the tax WDV, the timing difference, this is taxable temporary differences, and these taxable temporary differences are usually creating deferred tax liabilities. So because usually tax authorities are allocating the asset on lesser period, but accounting standard allow more period. So these temporary differences are creating deferred tax liability. But in the law, nothing has been given like this, that accounting depreciation will be different from the tax depreciation. At least we will not be seeing any deferred tax liability due to the pattern of allocation of the asset. But we need to wait for the regulations, and might be they will give more clarity in the regulations. In case it will be different, then we need to look into this. What will be the tax WDV? What will be the accounting WDV? So while calculating the taxable profits, we need to add back the accounting depreciation, and we need to deduct the tax depreciation, but we need to wait for it. These are frequently asked questions that will be taken from the Ministry of Finance side. So first question is, what is the UAE city treatment for any unrealized gain and losses? Unrealized gains and losses arising from accounting fair value or impairment adjustment. So where a business prepare, we have already discussed, just we need to go through this. Where a business prepare their financial statement on accrual basis, it has the following option in respect of the UECT treatment. Following options for the unrealized accounting gains and losses. Option number 1, the taxpayer can elect. We are not changing in a single word. We are just copied and pasted the question and answer from the ministry side. The taxable person can elect to recognize gains and losses on realization basis. So can elect on realization basis. So if you are not electing, it will be subject to tax on unrealized basis. For UACT purposes, for all assets and all liabilities, this word is very important. All assets, all liabilities, and that is any all unrealized gains would not be taxable. So if they are opting, all assets, all liabilities which are subject to fair value and impairment adjustment, it will be subject to tax on realization basis. Option number 2, taxable person can split capital account, revenue account. Revenue account, capital account, they can opt to be taxed on realization basis. Revenue account, they cannot opt. So taxable person, taxpayer can elect to recognize gains and losses on realization basis for UECT purposes for assets and liabilities held on the capital account only. This is important. So if you are applying, this is Article 23B, I think. This is Article 23(1). So B, they are asking for all assets, all liabilities which are on the capital account, the taxable person can opt to pay tax on the gains, accounting gains and losses on realization basis. That is only that is only unrealized gain and loss in respect of assets and liabilities. Assets and liabilities held on the capital account would not be taxable or deductible, respectively, until they are realized. Unrealized gain and losses arising from assets and liabilities held on the revenue account would continue to be included in the taxable income on a current basis. So unrealized will be treated on unrealized basis. Sorry, unrealized gain and loss unrealized basis, and unrealized gain from the assets and liabilities which they have opted related to the capital account, it will be subject to tax on realization basis. Generally, assets and liabilities are considered to be held on capital account when they are not expected to be sold or traded with during the regular course of the business operation. We have already discussed that non-current assets, non-current liabilities, usually it falls under the category of capital assets held, assets and liabilities held on the capital account. The question number 2, what is the realization principle and when income realized for the UECT purposes? We have already discussed it's based upon the sale. It doesn't matter either you are getting money from the customer or not. If you are selling it, so realization principle will be triggered. As per many other corporate tax systems, the UECT regime allows taxpayers to apply the realization principle for determining their taxable income. This means that income will only be taxable and deduction will only be able to be taken if and when a gain and loss is realized. Realization would happen, for example, when the relevant asset is sold or terminated. They are not asking either you are getting money from the customer or not. Once you are selling, the realization principle will be triggered. Under the realization principle, the taxable income for each tax period would exclude gains and losses in respect of assets and liabilities that are subject to fair value and impairment accounting. Under the realization principle, the taxable income for each tax period would exclude gains and losses in respect of assets or liabilities that are subject to fair value impairment accounting. Basically, you are saying this realization principle, if the assets and if the liability that already tax is being paid on the realization basis, so they are asking it will be excluded from it. How are capital gains taxed? Capital gain, though these capital gains, this is sale on the assets. It can be classified on equity and non-equity. Equity, different treatment we'll discuss in our next lecture. Non-equity, just we'll discuss in detail. Are capital gains exempt from UECT purposes? Yes, capital gains on the equity, if the conditions are being fulfilled, these are exempt. This is participation, basically, this is participation exemption regime. There's some certain requirement that the asset needs the share needs to be held by at least for a period of 2 years, 5% investment in the company, the certain conditions. If this all conditions are being fulfilled, then it will be exempt, otherwise it will be taxable. And other than this, all gains, other gain, capital gain would be treated as ordinary income and it will be subject to tax. This is over from my side. Thank you very much. If you have any question, you can drop me an email. You can drop an email to Faiza or any of us, and you can give us a call as well. It will be pleasure supporting you. As usual, we always listen you, we always understand, we always deliver. But apologies for the presentation, as I mentioned very beginning. So I'll try my best to share it maximum by the weekend. I appreciate it. Thank you very much. Thank you. Coming back to your questions. So for inventory, we have to add the margin that we expect to take and pay tax now, not now, by the end of every taxable period. So if you have bought an inventory, closing finished goods are in your bucket, and you are not opting all assets, you are not opting all liabilities, we are not basically, you are not applying Article 23(1), then you are means you are in the Article 23(2). If you are opting, then in this situation, all capital assets and liabilities in the capital account on realization basis, inventory itself will be on realization basis. So what will you do? You will consider the value, you will consider what is the cost of the inventory. By the end of the tax period, you will consider revalue the inventory. What is the market value of the inventory? What is the difference? On the difference, you will be liable to pay tax. and if there is a loss, this loss will be allowed for tax while calculating the taxable profits. Second question, sir, do we need to notify FTA which options are opting? Law says electing. I personally believe you will be required to notify, and it will be required the approval of the FTA as well. So if you are getting the approval of the FTA, then you can apply the realization principle. If you are not getting the approval of the FTA, then you will keep following the unrealization basis. Means on my sale price. Yes, you can say, Mushtaq, you are very right. On your sale price, whatever the market value is fair market value, it will be considered a sale price. So what is the market value? What is the cost differential of the inventory? If taxable, if the market value is higher than the cost, gain will be taxable in the same period. Otherwise, it will be allowed if this is less than the cost. If the cost and market value is same, then you are not liable to do anything. I requested for the PPT last time. I apologize for 3 and 4 times. Honestly, I'm so sorry, guys. It was such a busy schedule. As I mentioned, so many things are going on. Even last night, I was working till 1:30 till 2 o'clock. Anyway, give me some time. By the weekend, maximum, I'll be back. The issue is I can show you my presentation. This is in haphazard way because in every lecture I am considering the slide, and whatever the previous slide I'm not putting in the proper order. For all next slide, give me some time, couple of days. At the weekend, I will put the slides in order. I will send a PPT to all of you. I will send the PDF file to all of you. So thanks a lot, sir. Thank you very much, guys. If any other question, I'm here to address your all questions. You are pretty welcome. No further questions. Okay, fine, no problem at all. Thank you very much. If you have any question, you can drop us an email. Have a lovely day. Thank you very much. Have a lovely day. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.